bring this meeting to order. We'll start with the pledge.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
You have my seat.
All right. We have the roll call, please.
Laura Blaney.
Present.
Mike Jessen.
Here.
Sylvia Graham.
Here.
Andy Bozak. Red Stone.
Here.
Jeremy Rivas. Greg Sims.
Present.
Barb Regnan.
Here.
Jim Biggs.
Here.
Frank Brickner.
Here.
All right. And then we have the minutes from October 18th, 2022. I'll entertain a motion.
Motion approved.
Do I have a second?
Second.
Motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Okay, next is the reorganization. We'll start with the foundation president.
I'd like to nominate Laura Blaney for foundation president.
I'll second. Thank you. All those in favor signify by saying aye.
Aye.
Opposed, same sign. And we will move on to foundation vice president.
I'd like to nominate Red Stone.
Second.
I'd like to also nominate Andy Bozak.
Second.
Okay, we've got Redstone and Andy Bozak. What's the best way, Scott, to do that?
With the roll, just say who.
Should we go by roll? Should we?
Let's do 2 roll calls.
Okay,
So either yes or no for that person.
okay. So
So
the
this
first
is-
motion was for Redstone.
Yep. So this is for Red. Laura Blaney.
No.
Mike Jessen.
Yes.
Sylvia Graham.
No.
Andy Bozak.
No.
Red Stone.
Yes.
Jeremy Rivas. Greg Sims.
No.
Barb Regnan.
Yes.
Jim Biggs.
Yes.
Mike Brickner.
No.
4 to 5, no.
Okay.
Second roll call for Andy Bozak. Laura Blaney.
Yes.
Mike Jessen.
Did we, well,
You might as well vote yes now. Andy's going to be the vice president.
vote no the first round? Well, yeah. Hang on a second. We had one motion, the motion was for Red, that was voted down. And
now we have a motion.
and now we have a motion
For Andy.
for
Andy.
Andy. So feel free to change your vote if you support Red's no longer on the ballot.
Correct.
Correct?
Correct.
Unless it would be a tie, and it wouldn't have seemed to be a tie, so.
Correct.
Okay, all right.
Mike Jessen.
Yes.
Sylvia Graham.
Yes.
Andy Bozak. Red Stone.
Yes.
Jeremy Rivas. Greg Sims.
Yes.
Barb Regnan.
Yes.
Jim Biggs.
Yep.
Mike Brickner.
Yes.
All right, moving on. Under new business, first, we have the foundation earnings. The transfer, we're not prepared to do that. We don't need to do that. But I did want to point out that if we had not chosen to do smoothing, we'd be getting 0 right now. So maybe pat yourselves on the back a little bit.
Wow.
And to be clear, the foundation should take this up at their next meeting to transfer the 5.5 million to change to the holding account. But it's not right for tonight.
When you say 5.5.
Now let me clarify.
4.6.
Would this,
That's the next one.
yeah, that's what would be going to the holding account, right?
Right,
So,
so what we have is, we're blessed that we have enough money currently in the holding account that existed from last year, not including any money made in 2022 to be transferred in 2023, so 2021 money transferred in 2022. There's enough money in the current holding account to sustain the past foundation budget. The first 5 $2.501803 number is the smoothing number earnings for 2022 payable in 2023. The only reason why we're not ready to do that tonight is that resolution has not been completed, so it's not actually in front of you to sign and approve.
So this is the money that'll be waiting for next year.
Correct.
Okay.
And that smoothing's based on 3.25%, correct?
That's our spending policy. So.
Is
not
this smoothing based on
exactly.
40 quarters, 20 quarters? What's the, what is the smoothing?
I think we have, you're gonna get into
5 year,
that?
yeah, I'll cover it.
Yeah.
And you'll see it in print, that might help. It's
So,
5 year though.
When we get to the capital cities presentation, we can go through that in more detail. Let's move on to the resolution transferring foundation's earnings from the foundation holding fund to the foundation budget fund. And the amount of the transfer is $4,761,301.
I make a motion that we transfer the foundation earnings of $4,661,301.
Do I have a second?
Second.
All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Okay, Amanda?
Okay, good evening, everyone. Thank you for having me here today. My name's Amanda Black. I'm with Capital Cities. We're an investment consulting firm located in Indianapolis. We serve as a co-fiduciary of these assets and an outside advisor to the board. So today, what I'm going to present to you is a very abbreviated version of our annual market review. The reason I'm abbreviating it is I want to make sure we have time for the portfolio construction overview, where I'm going to give you an update on how the portfolio is positioned, the spending policy, the updated risk and return figures, and then kind of outline our projects going forward for the year. And then I'll end with a report on normal performance like we do every quarter. Sound okay?
Yep.
Okay, so for those of you looking in a book, if you would please turn behind the first tab, the one with the single dot on it, you'll see the market review. I am going to cover this really briefly. It's more of a reference for you to look at, covering what happened in the markets in 2022 and what we're looking at going forward in 2023. So on page 3, this is just a graphical depiction of what was happening quarter by quarter in the broad markets. So this is not the Porter County performance. The blue bars are broad U.S. stocks and non-U.S. stocks, and the orange bars are fixed income. Obviously, I think we all know that it was a very difficult year in the markets. Even though we had a nice rebound in the fourth quarter, it was not enough to make up for the downturn in the first 3 quarters. On the next page, just to put that into perspective, again, lots of information here. I'm just going to point you to a couple little things on each page. That chart at the bottom right, every single dot on that chart depicts a calendar year stock return and bond return. So if you look at the 2022 dot, what that is showing you is that the bond return was down 13% for 2022, and the stock return was negative 20% on the horizontal axis. And you can see just how unusual that was to have both stocks and bonds so negative at the same time. And all those other dots on that chart are different calendar years, so showing you how anomalous 2022 really was. On page 5, a lot of the reason behind that volatility in the market was basically the Fed trying to combat inflation by raising the Fed funds rate. One way to get a quick look at what that actually kind of felt like was to look at yield curves. So here on this chart, we can plot several different yield curves from different time periods and see how interest rates have changed over time. The orange curve at the top is where we ended 2022. Each one of those dots is basically corresponding to the yield of a treasury bond with the maturity shown along the x-axis there. So that's what a yield curve is. The yellow dashed line is where we were at the end of 2020, starkly contrasting with where we ended 2022. And that just shows you kind of the historic and unprecedented interest rate hikes and what that meant for yields. So even though we have this silver lining now of higher yields, there was a lot of price pressure and price depreciation within fixed income to get there. So significant volatility there. on page 6, there's a lot on this page. I'll just kind of characterize the general theme. The big question has been, can the Fed achieve a soft landing? That is, can the Fed raise interest rates enough to combat inflation without sending the economy into a recession? There are some signs that point to the fact that the Fed has perhaps achieved somewhat of a soft landing, and I kind of couch all of those comments. But what we can see is that the inflation rate has come down a little bit, but it's nowhere near the 2% target that the Fed would like to see. And at the same time, the labor market has held strong. So the bottom right, we see that unemployment has stuck right around 3.5%, and job openings have fallen, but not very precipitously. Now, these questions remain on the table. This story is not done being written. In fact, we have Fed meetings starting tomorrow. Many questions kind of surrounding whether or not the Fed will continue with rate hikes with what's going on in the market with the banking crisis. Will the Fed stick to just solely looking at data relating to inflation, or will the Fed try to avoid market distress and, what's going on with banking? So a lot of questions remain. One thing I want to just remind you that as stewards of these assets, we have a very long-term time horizon. And while we're looking at this and overseeing it quarter in and quarter out, we really can't try to make guesses about these big picture kind of economic inflection points. With that said, every one of your underlying managers welcomes volatility in the markets. They welcome price movements so that they can find new entry points. So it's not always just doom and gloom, even if there is volatility. Page 7, I'm not going to cover this. You can read this. Just there are things working in our favor, things that kind of headwinds. These aren't surprising. We saw these in 2022 and now kind of continuing in 2023. One thing that I'll touch on is that we are seeing higher expected returns. That's a big positive. With yields more than doubling from where they were a year ago, everything else following suit, we are looking at higher expected returns going forward, and that directly impacts your portfolio as well. Page 8, I think you all know this. These are just some points to think of about, as we are all stewards of these assets for the community. First and foremost, we always want to make sure we have the liquidity needs that, given your kind of spending needs, which we just talked about, and that's all working out well. We want to try to have as much diversification as we can. We know that we have to expose this portfolio to market risk to earn a return, so that we want to make sure we're, offering diversification. And then, of course, we're always following the investment policy statement. So just some quick points there. And I'm going to kind of end there because I want to then dovetail into the portfolio construction project. But first, let me see if there are any questions. Okay. So we're going to just go one more tab behind that. Now, this is normally a project that we would do in one single meeting. We would normally do this in May. With that said, we knew that there were some new faces around the table, so we wanted to kind of break this discussion into 2 meetings. So today I'm going to give you kind of a background of the portfolio, how it's positioned, how it's gotten there, what that means looking ahead, and kind of the big picture level set, so to speak. And then we can decide from there as a group where you want me to dig into detail at the next meeting. So this is kind of a 2-part thing.
Can I interrupt you for
Sure.
1 second? I didn't introduce you to the new people, and I apologize.
You're fine.
But we have Barb Regnitz right here, Amanda Black, and Red Stone sitting next to her.
Thank you. Great to meet both of you. Okay, so with this project, first of all, let's look at page 3. I kind of already alluded to this. One thing that is very important to capital cities as your co-fiduciary is that when we come and have this, time with you every quarter, we want to make sure that we're giving you your performance results. That's normal, that's what we're supposed to do. But we also want to make sure that each quarter we're doing a project directly relating to your fiduciary duty, so that at the end of the year, we can look back and see that we have documented all of the key fiduciary tasks over the course of a year. We view that very importantly as stewards of these assets. So we talked about portfolio construction. I'm going to cover that here, but that will also bleed into the next quarter a little bit. The August meeting would be the investment policy statement review that we do every year, and then the November meeting will be a comprehensive fee study. Those are always open to your, feedback or editing. Happy to move those around. So on page 4, when we talk about portfolio construction, also known as asset allocation, what we're trying to do is figure out how to customize an investment portfolio for Porter County, but we have to base that on different inputs. There are 2 broad categories of inputs. On the one hand, we have the market, stocks and bonds, and what will the market offer us in terms of risk and return. We also then importantly have Porter County's unique inputs. What are your spending needs? What is your risk tolerance? What are your unique preferences? For instance, the statutory code that limits the amount of equity that you may hold. All of those things have to be taken into consideration. So we think about all of that. We help you come up with an asset allocation. That is the amount of equities relative to fixed income. And then we can kind of show you, we can run charts on that, we can run projections, and then year in and year out, we want to check back in with you and make sure that's still meeting your goals. On page 5, in terms of what the market can offer, I talked about returns and risk. We can look ahead to what different asset classes ought to return. We are not economists at Capital Cities, but we, lots of other groups out there are. So we utilize Callan Associates forward-looking projections, and that's what you see on this page. So for instance, U.S. equity, the gray bar in the middle, U.S. equity should have a return of about 7.35%. That doesn't mean it's going to hit that every year. That means looking forward over a 10-year range, the average annual return ought to be somewhere around there. That's how you look at that. One thing on this page that I'll point out, the core U.S. fixed income number is now 4.25%. That is a very large improvement from what it was last time I came to you with this analysis. Last year, the predictions were that fixed income would only earn about 2 to 2.5%. So that's very helpful. So on page 6, we try to just summarize the things that are unique about Porter County. Here is where we have the spending policy listed. This was altered in September of 2021, which was extremely helpful and kind of bringing you more in line with your foundation peers across the country. It also allows you to have more consistency with your budgeting from year to year, and it also helps you it keeps you from spending too much when times are good, but it allows you to still spend when times are bad. So that's what smoothing means. So the spending policy is a 3.25%. You basically take that number, 3.25% times a market value, and the way we come up with that market value is it's an average of 20 quarters, rolling 20 quarters. So next year when we do this, we'll drop off the first 4 quarters and add the last 4. So I think I've touched on some of the key things. We've got the spending policy. So with it being 3.25%, we're not trying to swing for the fences here. We're trying to earn enough so that you can offset that spend with some modest growth. We're not trying to earn a return of 10%. There's a big difference there because we have to take into account the risk tolerance of this group. Long-term time horizon, all of your investments are liquid, 100% liquid, and we utilize both active and passive management. We've got some more details on that here in a sec. Any questions so far? Okay, so on page 7, what you see here is the target allocation for the Porter County portfolio. So this is outlined in your investment policy statement. You have a 55% allocation to equity. That is divided between some different types of equity. You've got an overweight to U.S. equity versus non-U.S. You do have some active management and some passive management, meaning you have some funds where they're just mimicking indexes, and that allows you to have broad market exposure with a low cost, but you've also got active managers in there as well. 45% in fixed income. Because that is a big piece of the portfolio, it is diversified quite a bit. Those are very active fixed income managers. This is not just buy and hold fixed income. You have several different styles at work, kind of with different duration, yield, quality types of characteristics. So when we run this portfolio with this exact asset allocation through our software that pulls in those capital markets projections, the expected return, this is a forward-looking guesstimate, is 6.4%. On the next page, sure.
With an expected standard deviation of 10.1, what does that mean?
10.1, so standard deviation is a typical measure of risk in the investment world. It's how much deviation should you expect around the mean. So the mean being 6.4%. So the average expectation would be that it would be normal for you to have plus or minus 10% deviation around that, and that would fall within a normal set of probability.
10% of the 6.4?
Yes.
Or 10%
Yes.
plus the 6.4?
Of the 6.4. So
Just
better,
misunderstood that.
yeah, I think a better way to look at it, thanks for that question, is on page 8. There's a chart there where we can actually measure, again, guesstimate, looking forward, what the volatility could be of your portfolio. And when I say that, I mean the volatility of returns. So for instance, look at the 10-year column on the far right. And you know what? I just realized this is the chart from last year. But let me still give you the example. The reason I know it's from last year is the expected median return over 10 years is 4.8. This year, it's now 6.4, so it didn't pull in the updated numbers. So I didn't mean to do that, but I can still show you then that standard deviation over 10 years, it kind of shows you what the volatility of returns could be. Now here, it looks like you add 10% to that. That's because I'm showing you the first percentile and the 99th. The more normal probability would be to show like a 10th percentile and a 90th, and then it would look much tighter. But what we're trying to show you is in an absolute best case scenario, over 10 years, this portfolio might earn up to 13% a year. In an absolute worst case scenario, it might lose 2%. So that's how to look at that potential volatility. Any other questions on that? So then, the bottom of page 8, and I'll give you an updated version once I get back to the office tomorrow. I'll send you an updated version of that chart. The bottom of page 8 is very exciting for us to see because it's the first time in a while that the expected return of the portfolio, and this is just not for you, this is for every foundation out there, is actually quite a bit higher than it has been. So with fixed income yields finally at a more normal pace and your expected return at 6.4%, the math is really in your favor here. So this is just basic math, but it shows you that if you earn 6.5% a year, you take away your 3.25% spending, you account for a normal inflation amount, you really should have real growth in this portfolio over time. So real growth to the corpus. That's good math. We like this. So on page 9, don't worry, I'm not going to cover this one, but we wanted to give you more detail on why are all of these different pieces in your portfolio. It's not just a 55% equity, 45% fixed income portfolio. There's a lot more to it. So we've kind of divided out all the underlying styles. We show what the role is in the portfolio, and then we list which of your managers fit into that component. So this is a good reference for you to have. At the bottom there, you're going to see the orange place, or the orange row where it says alternatives, not in the portfolio, to be determined. So that's been a big topic on the table with this group, and I'll get to that here in a second. So on page 10, I thought it might be useful just to kind of take us back down memory lane and remember, it doesn't seem that long ago, but it has been several years back to April 2016 when we all kind of collectively put this portfolio to work. If you all will remember, thanks to the legislation change, you were able to take the hospital proceeds, move them out of cash and short-term fixed income, and put them into a more typical institutional investment portfolio. So we did that in 2016. We all got our feet wet doing that, monitoring that, following that closely. And then once we had a few years under our belts, we started to make enhancements to the portfolio prudently over time. So in September of 2020, we did some work with the active equity managers. A year later, we did work with the active fixed income managers. And then we've had some more impactful changes here recently over the last year and a half with the spending policy enhancements, thanks to House Bill 1407. And then that also led to an increase in the equity of the portfolio. So the equity percentage used to be 40%, it's now 55%. And that's, again, within those statutory code parameters outlined for you. And then more recently, last summer and into the fall, the big topic on the table was alternatives. A lot of education there. What are alternatives? Why are we looking at this? What are the pros? What are the cons? What are the complexities? And that's really where we find ourselves today. We feel very happy with the evolution of the portfolio in terms of the diversification, the added equity, the updated spending policy, all of your active managers. We could be just fine where we are with the portfolio, but we still feel like it's our job as your advisor at Capital Cities to bring you, best ideas. And alternatives is the kind of the most natural thing for you to consider at this point. A couple notes on the bottom, though, before I kind of pause and get some feedback. I did want to point out that since inception of this portfolio, $31.5 million has been dispersed out of the portfolio. The total return has averaged 5.0% on an average annual basis. Now, the number used to be much higher than that. We had 2022 bringing that down significantly. But even with 2022 in play, 5.0% is exactly what the goal was when this portfolio was first established in 2016. So I did want to note that. The cumulative return during that time has been 38.5%, just kind of reflecting, what positive compounding can do for the portfolio. And that 38.5% would correspond, if you were to just liquidate everything right now, that would correspond to almost $52 million in gains. So where we stand now is we would still like for you to consider alternatives. If it's right for the portfolio, that's kind of dependent on what this board thinks. With some changes and different people kind of on the board, we thought it made sense to take this slowly. This is not something we're trying to pull the trigger on immediately. So what I thought we would do is provide this level set today, but then plan to come back at the next meeting where we would dig into more of the detail. But I have gone ahead and included it here so that it's not new information when you see me next. I've talked a lot. Let me pause and see what questions you might have.
Does anyone want her to go through the alternative assets? I know you understand it. Does anybody want a refresher so we can think about it again? Okay. All right. Any other questions? Skip past that.
Okay. And then let me cover performance. So in the book, that will be the very first section in front of the very first tab. And then on the computer, it's the probably December 31 report, if there's something that looks like that. So we can skip the market review because I think we've covered that enough with the 2022 review. So if you go at the bottom, where it says page 6 at the bottom. Yep, that's it, thank you. And it's page number 6 at the bottom. I don't know if it corresponds to the PDF. Okay, so again, we're looking back a little ways here. Looking back to December 31st, 2022, the portfolio ended the year with a market value of $163,563,708. We did see a really nice return for the fourth quarter, that 6.4% return, which outpaced your benchmark rather materially. However, we're still looking at a tough return for the full calendar year of negative 13.7 relative to your benchmark. You did outperform the benchmark. I know that's not a lot of solace when you see double-digit negatives. At the top, you see those pie charts. Those show you that you are in line with your investment policy statement allocation. So everything in here kind of ties back to the investment policy statement, and we try to just summarize it for you here. I'm not going to cover a whole lot of the report, and I'm always happy to walk anyone through it, if anyone new kind of wants to go through it offline. We always try to just start out bigger picture and then drill down into more detail as the report goes on. A couple pages that I'll highlight, we always have our stoplight grid on page 7. That's where you can get a really quick snapshot of Capital City's view of each of your underlying investment managers. There are no changes to that from the last several quarters. Page 8, we go through your asset allocation compliance, making sure you're within those plus or minus 5% bands for equity, fixed income, cash, et cetera. The yellow means that you're in policy, so that's just a chart where you can see that. And then on page 9, I will show you a couple things here. So page 9 is where we show you more detail on your performance. We show it relative to your evaluation benchmark, which is just a passive target, identical to your asset allocation, but it's passive investments, so it shows you how would you have done if you had just been using passive investments. And then you can see your portfolio return relative to that. And then that 5% performance target, which was set out in the very beginning of all this, is also included. The gray box is a peer group, not a perfect peer group for this portfolio, but it's the best we have. It is literally just all foundations under $1 billion who submit their data to this database that we use, and we use the Investment Metrics database, which is a very commonly used database within the investment industry. So a couple things to point out here. I did note that your one-year performance was negative 13.7. That puts you right in the middle of the peer group. That's what that 51 next to it means. That's the 51st percentile. You did outperform your benchmark, and the reason for that was really that your fixed income managers held up considerably better than the market. I talked about the kind of extensive diversification we've tried to build into that fixed income, and that really did help. So you didn't have just all interest rate exposure. You had managers doing different things, and that helped a little bit there on the margin. One other page I'll show you, page 12 with the line chart. This is that 38.5% cumulative number that I pointed out a second ago, and that corresponds to just shy of $52 million in gains if you were to just sell everything tomorrow. That's what those numbers mean. You can see the ending market value there, and I'll bring you updated here through yesterday's close. So again, what you see here is 163.5. The new number as of yesterday, and today was also positive, but I only have through yesterday, 166,351,496. We have seen some mixed results in the almost first quarter of the year. Some ups and downs, but that is a 1.7% positive return thus far. So I will cease fire here. There are lots more detail here if anyone has any questions, but those were the points I had planned to cover.
Does anyone have questions right now?
Well, I just have a comment, maybe you can, I found out that just fixed income through my bank, I found out that I can get 4.5 interest with $25,000, a very minimal amount of money, but for a short amount of time. And people aren't aware of this, but where does that stand? Is there any hidden accounts out there that we should be taking advantage of with this type of thing going on?
That is a great question, and this is precisely why we're so happy that you have active fixed income. So let me give you an example. If you look at the listing on page 11 there, just because it's right above where we are, the Carillon Reams Core Plus Bond Fund. Reams is an active fixed income manager. They're actually located in Indy. They moved from Columbus, Indiana to Indy. They are salivating. They're chomping at the bit with the fixed income yields right now. But they don't need to go buy a CD for 4.5%. They can buy a 1 to 2 year treasury for 4.5% and then turn around and sell it and buy something else the next day if they want to. So For a manager like that, who's trading in and out of the market, day in and day out, hour in and hour out, they know that those yields exist, but if those yields exist in CDs, they're also going to exist in short-term corporate bonds and asset-backed securities. So they are getting those same yields, just in a slightly different way. One where it's more active, meaning, and they're not tied to it. There's no liquidity kind of lockup.
Yeah.
So great question. Your managers are absolutely doing that and benefiting from it. I was studying one of Ream's portfolios for one of the universities with whom we work, so it's not the exact same portfolio, but the overall yield on their portfolio was like 6.2%, and at this time last year, it was 2.6%. So the yield environment is nearly astounding. So everyone out here needs to do what Sylvia's doing, go to the bank. But that's a great question. Thank you for asking that. The other thing is your 2% cash allocation is, that's also earning something for the first time, I think, really since we've started doing this.
I mention that because the public may not all be aware of that. And this is important for the
Yes.
average person.
Absolutely.
Anything else?
Well, thank you all. I
Thank you
know that
very
was a
much.
lot of time there, so I appreciate it.
I'm glad you did.
Okay, thank you.
Okay. The attorney's report makes me realize we did not officially choose our attorney for the year. So we probably don't have,
Motion for Greg Sid.
so I'll entertain a motion.
Take care.
I make a motion, we retain Scott.
Sylvia made a motion to retain Scott McClure as our attorney.
Second.
And I have a second. All those in favor signify by saying aye. Aye. Opposed, same sign. Motion carries. Scott, can you put a contract together for next meeting? Thank you. All right, and do you have anything for today on the attorney's report?
Now, the next meeting, we'll have the resolution for the transfer of attorney to last.
I have a question about that. What is our balance in that fund? And does it make sense to leave it and build the principal since we had such a bad year? I mean, what if we don't need to take it out? Because didn't we have a pretty decent cushion?
Well, I think now, with the 4.7, my rough math in my head says we probably have like 2.8 left in that account.
So we need money.
I'm close? Yeah. There's basically 6,787,000 in it now. We transferred 4,761,000 and change out of the holding account for the 2023 foundation budget. The 5.5 million is the smoothing number from 2022. So we would need to, we're obviously anticipating the foundation budget to be remaining somewhat in that vicinity, so the board could take up the discussion to only transfer enough to say, get us to 5 million or more in the holding account, but I think, the holding account would only have about 2.7 or so in it now, wouldn't sustain next year's foundation budget, so most likely, we probably need to transfer this. If we don't, then, or at least the vast majority of it needs to get transferred to the holding account.
Does anyone else have any thoughts about that one way or the other?
6 of one and half a dozen of another, because if we need the money, we could just transfer it all, like he's
It'll be
suggesting.
cushion.
Yeah, it'll be a cushion, but if we need it, we can take it out.
What's the next quarter gonna
But-
be?
but-
Is it gonna go up or down?
But what?
But to be
Let me get my
clear,
crystal
if
ball
we-
out.
Wait,
If the board decided to take less than the smoothing amount of the 5,501,803, that money goes, when it goes back to the foundation, would become principal.
oh,
Then would take 10 votes to move it.
yep, yep.
So that would be a difference, wouldn't just be, let's say we transferred $3.5 million, and there was we couldn't just act as
I
if
got
2
it.
million was readily available by a majority vote.
Okay. Just wanted to have the discussion. Let's go to approval of claims. We've got Capital Cities, fourth quarter 2022 and first quarter 2023. Together, they total $32,500.
Move to approve.
Second.
Got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. And then we've got our audit financial statement by Kat Sepper Miller, and that was for the year ended December 31st, 2021, at $6,000.
Motion approved.
I second.
Got a motion and a second. All those in favor signify by saying aye.
Just a real quick question. Why is there a $13,000 credit? Less progress bill? This
Where-
bill's for $14,000, it's got a $13,000 credit, and that's where we get the $6,000.
Where are you seeing that?
One for 5.
What?
There's another one for 5.
Yeah, there's one for 5, and then there's one for 1,000, but it's got a $13,000 negative on it.
That's the balance that we've already paid.
Oh, there.
No, they did progress billing throughout last year, so that's what we'd already paid. That makes sense, I don't know if that's exactly what Joy said or not.
Yeah.
Not a discount, already made
I was hoping it
payment.
was a discount, but okay. Thank you, guys, sorry.
Now that that's clear like mud. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carried. And any other matter that may properly come before this board? Does anybody have anything? Anything from our bankers? Well, thank you for coming. Sylvia tried to get people coming your way.
Yeah.
Sylvia, I can beat that rate, though.
I want to tell you, I went in and saw my banker, and I said, hey, I've been offered this, and they said we could beat it. So you're saying you'll beat theirs?
All right, well, thank you, everyone, for coming. The meeting is adjourned.
Thank you.
See you guys. Have fun tonight.
Okay.